Welcome back to EDS, and in this video I'm going to show you how to make money in the markets without guessing direction. It doesn't matter whether the market goes up, down, left, right, sideways. I'm going to show you how to make money no matter what. So the first thing you want to do is, of course, open up your brokerage platform, and then you want to go over to your watch list. This is just a pre-made default watch list. You can use any watch list that you like. Just make sure you have a nice diverse range of underlyings, and what you want to do is you want to have IV rank up on your watch list, and you want to order the watch list from high to low IV rank. The reason for this is because we are going to be writing options contracts, and options prices are affected by volatility. So when volatility is high, option prices are high, and because we're going to be writing the contracts, that effectively means that we are short the contracts. So anytime you're short something, you want to sell high, buy low. So we want to sell when volatility is high. That's when option prices are high, and then play the contraction back down to the mean or further below. And one of many reasons why this strategy works so well is because volatility is mean reverting, and volatility is actually contracting in the market about 80% of the time. So once you've got everything set up like this, you want to only look at underlyings to trade that have an IV rank of at least 30. So anything 30 and above is okay to trade. Anything less than 30, you want to kind of give it a miss. Over 50 is a very high IV rank. So 30 is high, 50 is very high. And I personally like to be in and around the mid to high range. And at this point, what you want to do is go down the list and see what would fit well in your portfolio, because you want to keep things nice and diverse. You don't want to be too heavy in any one sector or underlying. And also the size of the underlying, so for example how much it's trading for, is going to affect how much buying power is going to be required to open this position. So if you do have a smaller account, stick to the smaller underlyings. If you have a larger account, feel free to trade anything you like as long as it complements your portfolio. And once you have picked something to trade, you want to make sure it's liquid. We have a liquidity indicator here, and this isn't the liquidity of the underlying, but this is the liquidity of the options market on that underlying. So you want to have some kind of liquidity indicator. If you don't have a liquidity indicator, I'm going to show you how to manually assess liquidity. So we're just going to go with Intel right now. So Intel is trading at under $20. It has an IV rank of 45.6. It has an absolute IV level of 49.3%. As you can see, it's quite a small underlying, so this will fit into most people's portfolios, or pretty much every portfolio really. And I'm going to show you exactly what to do. So once you've got your underlying selected, you want to then pull up a list of expiration dates for that underlying. Specifically, I'm talking about option expiration dates, and you want to pick an expiration date that's going to be between 30 and 60 days out in time, and you want to make sure it's a monthly, not a weekly or quarterly expiration date. So we've got the March 21st expiration date with 41 days left on the contract. So we're going to open that up, and now we are presented with the options chain. So one thing to keep in mind: this is a Saturday. The market is closed, so take these bid-ask prices with a slight pinch of salt. But very quickly, we have calls on the left, puts on the right. This horizontal orange line shows us where the price of the underlying is with respect to the strikes. We have our dotted blue lines that show us our standard deviation levels, and we also have our expected move visually displayed as well by this vertical orange bar. It's also displayed in parentheses next to the implied volatility. Your broker may or may not show it visually like this, but it should always display the expected move, and it will typically be next to your IV. So in order to assess liquidity manually, what you want to do is you want to look at the bid-ask spread. So as you can see here, the bid is 0.94, the ask is 0.97, so it's a couple pennies wide, and it's a couple pennies wide on the put side as well. And it does kind of widen a little bit as you get further out. But also you want to, but we're not really going to be selling contracts this far out anyway. We're going to be in and around the one standard deviation level. So as you can see here, the bid-ask spreads are fairly tight. And these numbers are to be taken with a pinch of salt because, of course, the market is closed. As soon as the market opens on Monday, this will all tighten up. So, without further ado, we want to simply sell one call and one put. And we want to sell outside of the expected move because when we are writing contracts, when we are short contract, we want price to stay away from that contract. So, if we know what the expected move is, we can just sell outside of that. The further out you go, the higher your probability of success will be. But the further out you go, you will have a lower return on your capital because you will collect less premium up front. So I like to be around 15 to 20 deltas. So if we go on the delta column here, as you can see, we have an 18 delta at the 23 strike. And we also have there isn't an 18 delta on the put side, there's a 12 and a 21. So we'll just be a little bit more aggressive and go with the 21. But by all means, you can be more conservative and go with the 12. So let's just start with the 12 and see where that lands us. So what we've done here is create a range for ourselves. So we want price to stay in this range. Whether the market goes up, down, sideways, it doesn't matter as long as price is within this range in 41 days time. And what's the likelihood of that happening? Well, if we look in the bottom left corner, as you can see here, we have a pop of 60%. The actual pop would be much higher. It's just because the market's closed right now, it'd be close to 70%. But even if we just go off 60%, it's still very high. Anything over 50% is considered to be a high probability trade. And if we don't want to wait all the way till expiration, say if we just want to get out at 50% of max profit, we have a P50 number here, which is the probability of hitting 50% of max profit at some point over the next 41 days, and that's 76%. This again would be higher at market open, closer to 80%. So we'd be looking at probabilities of success of between 60 and 80%. So very, very high probabilities here. And as you can see, this is the price that we would try and get filled at, 0.52, which is $52. So if we were to get filled at this price, $52 would be deposited to our cash balance automatically by our broker, and we keep that no matter what happens. And the broker is going to require $231 in buying power to open this position. So we're getting a pretty nice and healthy return here, and this is in 41 days, and we're being pretty conservative with our strikes. So let's say if we be a little bit more aggressive and go to the 21 delta and say the 24 delta, we're still around the one standard deviation level, and this is still a very high probability trade. Our P50 is still 73%. In actual reality, it probably would be a little bit higher than that. But as you can see, still very, very high probabilities of success. And now we are collecting $81 up front, and our buying power requirement is $215. So we're getting a higher return on our capital here, close to 50%, and this is in 41 days. Okay, so that's how you do it, and that's basically everything you need to know about putting on a naked position. This is a naked or undefined risk position. This will fit inside pretty much every portfolio. This is just one example, but you just want to do this as many times as you can. But you want to keep your position sizing in check as well. And in order to figure out how much buying power you should be allocating to your positions, we've got a free position sizing template for everyone to use. The link is in the description. And the way it works is you enter in the size of your portfolio. So say if it's $10,000, and then you enter that, and then below you'll then enter in whatever the current VIX level is. So say if it's 12.3, and then below everything will be automatically calculated for you. All you need to do at this point is just use this information to form the backbone of your portfolio. So for example, in this instance, $700 would be the maximum amount of buying power to allocate to a single undefined risk position. And as you saw in the example that we went over today, the buying power requirement was just over $200. So that position would comfortably fit inside of this example portfolio. But as long as you use this over the long run, you'll be absolutely fine. And if you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium and get yourself signed up. Inside you will have access to our portfolio that will allow you to see the positions that we place, how we manage risk, how we make adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish, and it is a private community, so if you ever get stuck at any point, you can speak directly with myself or with other like-minded individuals, and there's a 100% money back guarantee. So if you've been through the full course, follow some of our trades, and after 6 months, if you're not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. Right now it's $9.99 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life, so you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to give you the skill. Once you've learned it, it's something that you can take with you for the rest of your life. No one can take it away from you. And we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months you should be good to go. So with that being said, I will see you guys on the inside.